Most investors see a stock sitting 30% below its recent peak and instantly assume the business is broken beyond repair. They write it off, they move on. But what if that exact same company is quietly orchestrating one of the most aggressive financial turnarounds the entire electric vehicle market has seen this decade, right under everyone's nose? That's the puzzle we're cracking open today. Wall Street is now flashing signals pointing to more than 30% upside on this name. Goldman Sachs just flipped bullish. Institutions are piling in. But buried inside all of this optimism is one enormous catch, a single number that could shatter the entire bullish case overnight. And by the end of this video, you'll understand exactly what that catch is and whether the reward is worth the risk. If you love breakdowns that go beyond the headlines and dig into the real numbers, do me a quick favor and hit that subscribe button. It genuinely helps the channel grow. Now let's look at the numbers driving this hidden momentum. Right now, NIO is trading just under $5 a share, sitting roughly 30% below its April peak. On the surface, it's the easiest thing in the world to dismiss this as just another struggling Chinese EV maker caught in the crossfire of a brutal macroeconomic environment. But then something strange happened. Out of nowhere, we saw a multi-day rally push the stock up over 3%. So what lit the fuse? Goldman Sachs. And they didn't just nudge their rating higher, they flipped all the way to a buy, slapping a $7 price target on the stock and pointing directly to a massive turnaround brewing in NIO's premium SUV segment. Now that sounds impressive until you look at what's actually happening beneath the surface. Because the fundamental story here is a brutal, high-stakes tug-of-war between two completely different markets. On the domestic front, the bulls are salivating over a projected swing to profitability and dominant market share gains. But turn your eyes internationally and the picture gets ugly. This company is bleeding overseas. We're talking about openly admitted flaws in their European strategy, forcing deep, painful price cuts for their Firefly brand across Norway and Portugal. And it gets worse. They've absorbed heavy customer backlash after rolling out unannounced, quiet promotional discounts on their mass-market Envo L80 SUV, alienating the very buyers who paid full price weeks earlier. That sounds genuinely terrifying until you see how they're performing against their rivals on their home turf. Because this is where the entire narrative flips on its head. Consider this. The broader Chinese new energy vehicle market didn't just cool off in the first half of 2026. It contracted by 14%. That's a shrinking pie. Now, in that exact same brutal, hostile environment, most companies would be posting declines. But NIO? NIO delivered a record 107,658 vehicles in the second quarter. That's a staggering 49% jump year over year. In the month of June alone, they pushed out over 40,000 units. Let that sink in. They are massively outperforming a market that is actively shrinking, capturing a commanding 39% market share in the premium SUV segment. But here's the thing. Selling more cars is one battle. Actually making a profit on them while global supply chains are cracking apart, that's an entirely different war. And this brings us to one of the most brilliant, under-the-radar financial maneuvers I've seen any car company pull off all year. Raw material costs and memory chip inflation were absolutely soaring, piling nearly 20,000 yuan onto the manufacturing cost of their flagship ES8. So what did NIO do? Did they just eat the loss? Did they hike prices and scare away customers? Neither. Instead, they executed a razor-sharp $23,300,000 investment to secure a stake in the IPO of CXMT, China's largest DRAM manufacturer. Think about the genius of that move. They literally bought into their own supply chain to hedge against hardware inflation and shield their margins from the storm. So they're selling more cars, and they're actively protecting their costs. Which brings us to the one question every investor actually cares about. How is this thing currently priced? You'd expect to pay a hefty premium for this kind of growth story, right? Well, prepare to be surprised. NIO is currently trading at a price-to-sales ratio of just 0.8 times. Now compare that against the 2.1 times average of its pure-play EV peers. What you're staring at is a massive 25 to 29% valuation discount. And here's the kicker. They aren't going to go bankrupt while waiting for the market to wake up. They maintain a current ratio above 1, and their first quarter gross vehicle margins actually improved consecutively, climbing to 18.8%. Retail investors might still be nervous on the sidelines, but the so-called smart money is telling a radically different story. Because institutions now own over 48% of this company, and they aren't just passively parking their cash, they are aggressively accumulating shares. Bank of America increased its stake by an astonishing 99%. Renaissance Technologies bumped theirs by over 70%. Citadel piled on another 40%. We even watched ABC Arbitrage initiate a brand new $4 million position from scratch. Now sure, a handful of players trim their exposure. That always happens. But the overarching, undeniable theme here is massive institutional accumulation at these depressed price levels. And now, Wall Street's analysts are finally starting to align with that institutional flood of capital. While the broader official consensus technically still reads as a hold, you have to look underneath that label at the actual price targets. The average target range sits between $6.42 and $6.70. From where the stock trades today, that implies an upside of well over 30%. Goldman Sachs is leading the charge at $7 flat, and even the more conservative voices, like Bernstein's market perform rating, still peg the stock at $6, comfortably above where it's trading right now. But here's where the story gets genuinely aggressive, and exactly why Goldman is beating the bull drum so loudly. We are looking at a projected fundamental transformation, a company morphing from a cash-burning startup into a cash-generating machine. Rewind to 2025, and NIO posted a jaw-dropping 12.4 billion yuan net loss. Now fast forward. For 2026, analysts are modeling a dramatic operational turnaround that flips that into a 1.6 billion yuan net profit. That is a historic swing in the making. But it gets even better. Free cash flow is projected to swing aggressively into positive territory, all the way to 12.1 billion yuan. If this plays out, it marks the definitive era-ending close of NIO's cash burn chapter. But before you rush off to hit that buy button, there's a mechanical layer buried inside this market that could ignite immediate explosive volatility. Because there's a shadow hanging over this stock. Over 130 million shares are currently sold short, representing roughly 5.3% of the public float. Now that figure has actually decreased slightly month over month, a subtle hint that the bears might be losing their conviction. But here's the number that matters. The days to cover ratio sits at 4.3 days. What does that mean in plain English? It means if NIO keeps rolling out undeniably good news, there is more than enough built-up pressure in this market to trigger a short squeeze, forcing panic bears to scramble and buy back their shares at rising prices. And if you zoom into the options market, you can see with crystal clarity exactly where this battle is being waged right now. Heading into the mid-July expiration, NIO was trapped in what traders call a pin. There was an enormous concentration of volume and open interest sitting right at the $5 strike. Over 18,000 calls and 14,000 puts stacked up. This colossal wall of options acted like a magnet, keeping the stock pinned just below $5. But underneath, there's a very firm put wall providing solid support down at $4.50. So here's the setup. If NIO can cleanly break free from that $5 gravity well, the next major upside resistance levels don't come into play until $5.50 and then $6. Now this all looks like the perfect bullish setup, but there's one number lurking just ahead that makes this entire rosy conclusion far, far harder to defend. This is the reality check nobody wants to talk about. To actually hit Goldman Sachs' aggressive 43% full-year growth projection, NIO has to mathematically accelerate its sales at a blistering pace. They need to average 45,850 deliveries every single month throughout the second half of 2026. Now remember what we said earlier? Their phenomenal, record-shattering month of June only produced roughly 40,600 units. Do you see the problem here? They essentially have to beat their all-time best month every month for the rest of the year without a single stumble. There is absolutely zero room for execution errors. And selling all those cars means nothing if they have to torch their pricing power to do it. Which brings us to the second massive hurdle, margin preservation. The entire golden path to 2026 profitability hinges on defending that roughly 20% vehicle margin on their premium ES8 and ES9 models. Yes, the CXMT investment brilliantly hedged their hardware costs. We covered that. But the real lurking threat is a domestic price war. If competitive pressure forces NIO to slash prices on its premium lineup, exactly the way they were forced to with the Onvo L80, that entire profitability timeline collapses. And when that happens, the $7 price target becomes completely, hopelessly unachievable. So, taking every fundamental, all the institutional buying, and these enormous risks into account, how do we actually trade this thing right now? For the tactical trader, there's a highly structured, actionable setup on the table. With the heavy July options expiration now out of the way, the stock finally has room to breathe. The play here is a long entry between $4.80 and $4.85 on a pullback, or alternatively, buying a confirmed daily close above $5.05. You anchor your risk with a hard stop loss at $4.45, leaning on that strong option support beneath you. Your first profit target sits at $5.38, which is the exact convergence point of the 50-day and 200-day moving averages. Breaking cleanly above that flips the entire macro trend bullish, unlocking your second target all the way up at $6, which brings us to our final verdict on whether NIO is actually worth your hard-earned capital in 2026. In the short term, NIO looks highly investable. That 5.3% short float provides genuine squeeze fuel, and the heavy institutional buying creates a very favorable risk-to-reward ratio for a tactical trade up to that $5.38 level. Zoom out to the long term, and you have a company successfully transforming from a cash-burning startup into a structurally profitable enterprise, backed by smart supply chain hedging and genuine dominance in the premium market. But here's the caveat, and this is the one thing you absolutely cannot ignore. You cannot simply buy this stock and forget about it. You have to aggressively monitor their second-half monthly deliveries like a hawk. If they aren't consistently hitting that 45,850 run rate, the entire bullish thesis falls apart at the seams. The potential upside here is massive, but the execution has to be absolutely flawless. Before we wrap up, a quick but important note. Everything discussed in this video is for informational and educational purposes only. It is not financial advice, and I am not a licensed financial advisor. All investing carries risk, including the potential loss of your capital. Please do your own research and consider speaking with a qualified financial professional before making any investment decisions. Now I want to hear from you. If NIO fails to hit that critical 45,850 monthly delivery target, do you think the stock revisits its lows, or do you believe the institutional support holds the floor no matter what? Drop your prediction in the comments below. I read every single one. If this breakdown gave you a clearer edge, smash that like button and subscribe so you never miss the next deep dive. I'll see you in the next one.